Well, first of all, Amit, thank you very much for your stimulating and thoughtful lecture. You've shown how the intersection of technological advances and an environment of increased regulation have led to a rise in shadow banking. And you've also given us advice on how to analyze the impact of regulatory policies on banks and shadow banks simultaneously. You may remember that Andrew Crockett also often drew attention to the fact that financial liberalization can promote efficiency and improve resource allocation, but that comes at a cost of a higher likelihood of financial crisis. Likewise, Amit in his lecture asked us to take stock of the changing economic landscape and also to respond accordingly. I'm convinced that the role of shadow banking and financial technology and financial intermediation deserves special attention by financial regulators, but also researchers alike. All the more as the Financial Stability Board finds in its most recent monitoring report on the topic that already in 2017, non-bank financial intermediation reached $52 trillion globally. What is more, we are of course all aware of the plan recently put forward by a consortium of companies led by Facebook to introduce a stablecoin whose value is to be pegged to a currency basket and covered by a reserve fund. And if this stablecoin were to be widely used, this could have, of course, have important implications for payment systems worldwide, but also for financial stability and monetary policy. This may be just one prominent example. More generally, we should not mistake shadow banking and the role of fintech and big tech companies for a niche topic, but focus on possible implications. Apart from vulnerabilities to cyber attacks, credit provision by fintechs and big techs could be also more pro-cyclical than traditional credit, for instance. Also, issues beyond the traditional remit of financial regulation could arise, such as the abuse of market power through dominant technological platforms and the protection of customer data. On the other hand, credit provision by fintechs, for instance, can provide potential benefits in terms of financial inclusion and the diversification of funding sources available to the economy. So many other interesting questions come up surrounding fintechs and shadow banking. For example, also how structural changes in financial intermediation affect the transmission of monetary policy, which is, I guess, a topic dear to all of us. But before I delve too deeply into such topics, I would like to open the floor for today's panel. I will ask each of the panelists to speak for 10 minutes, and then I will open the floor for question to Amit or the panel. And let me start in alphabetical order. So Alejandro will go first. Please, the floor is yours.
Thank you, Jens. It is an honor to be here at the BIS celebrating the life of Andrew Crockett. On this occasion, I will focus on four key areas. The first one is how technology has had a transformational effect. The second is how that transformational effect manifests into competition and financial inclusion, financial deepening. The third, share some Mexico's experience regarding fintech. And fourth, talk about some regulatory challenges ahead. As a background for transformation role of technology, I think it's very clear that one of the lessons from the great financial crisis showed us the importance of having adequate regulation in place to keep up with the challenges of financial innovation. Imperfect understanding of risk distribution in complex products, short-sightedness in the evaluation of risks stemming from new financial activities and services, and the importance of having aligned incentives. And also how critical could be the reduction of regulatory costs and increase in leverage. So it is and it was imperative to close regulatory gaps and some of these deficiencies. Systemic risks can only be diffused if they are first identified. So bringing shadow activities into the light and understanding them better, I think it's critical, and I think your paper goes far in that agenda. Now, talking about fintech, there is a new wave of innovation in financial services. Clearly, fintech could be highly disrupted into the system. New credit origination mechanisms are growing rapidly, changing and enhancing competition. Exponential growth in technology increases economies of scale. Communication technology, smartphones and internet offers an extremely valuable network to provide financial services. An open architecture where anyone can create technological solutions is clearly changing the landscape. And technology is sharply reducing fixed cost to provide financial services. Now let me go into some of the potential implications of fintech innovation in competition and financial inclusions. Fintech opportunities differ from depending on the level of maturity and financial depth in each country. Deep or mature financial systems, like advanced economies and in some emerging markets. For example, and this is clearly for the evidence from Amit's work, funding is very important. You need strong market-based financing or government institutions. Wholesale markets and private equity firms are very important regarding funding. The other element is data. Data can be easily available or it will be hard to come by. And this is critical to analyze consumer and transactional information. And the third one is network and the type of infrastructure and APIs that are in that market. These elements, when they are, like in the case Amit talked about, promote strong competition in credit origination and also in asset management, reducing the cost to personalize financial services and allows to virtualize financial services. For less mature financial systems, and emerging markets clearly come to mind, there are other important benefits, since technology allows to advance exponentially in financial deepening and inclusion. The need for physical branches has been reduced by smartphones, and they really offer a new services network. For all jurisdictions, technology can be a disruptive force for the financial system, and we need to make the most out of it and mitigate potential risks. And I will mention two, operational risks and cybersecurity. Challenges for financial markets, and clearly banking sector may face strong competitive forces. These may imply lower profit margins in banks and move towards riskier segments, as also comes from your work. And some banks can act quickly and partner with new entrants, and others may stay in the old segments. Banking supervisors and regulators need to adapt to the new challenge of supervising the new structures and activities with a steep learning curve and human capital creation. Among the implications for financial authorities, key drivers for regulation design, I will mention that we need to change our regulatory and supervisory mentality from a silo institutional approach to an ecosystem, multiplayer approach. We should take a forward-looking strategy and not be lulled by false sense of safety and innovation. Increase urgency to understand the new interconnections and risks and to cooperate with peers across borders. Also change the regulatory approach from institution-based to modular approach. Now let me share now into the third part some of the fintech issues in Mexico. A recent survey conducted in Mexico shows that there is a big potential for improving financial inclusion. About 70 million people have access to a smartphone, but only 30 million has a banking account. So the potential for financial inclusion is huge. The share of the population between 18 and 70 years old that have not used any credit product is around 43%. According to the Global Financial Findex database, only 32% of the population used digital payment services, compared to 58% in Brazil, 65% in Chile, and 98% in Canada. So there is a significant room to grow. Fintech services in Mexico have concentrated in remittances and payments, and more recently in consumer and corporate credit and financial services. Now let me talk some about fintech regulation. The main objective of our regulation is to empower the consumer and provide high-quality financial services. Some of the key considerations are consumer protection and safety in managing the consumer resources, legal certainty for corporates and consumers, prevention of operations with illegal funds, and systemic risk prevention. And what is the role of central banks? I think central banks' response to technological innovation can be and play as a catalyst. Build a highway for financial services, particularly payment systems. For this to happen, the payment system must be constructed with the highest technological standards and must have a proper and clear regulation to ensure risk mitigation. Therefore, payment system must consider the widest possible interoperability, real-time services, business continuity on a 24/7 day basis, highest cybersecurity standards, and the private sector connecting into this highway to provide additional high value-added services. The goal is to have a seamless, secure, and efficient financial transaction and payment system. A good example of this initiative is one being currently conducted by Banco de Mexico, known as CODI. You see, it is going to be a new mobile-to-mobile payment infrastructure that constitutes an environment for innovation that will allow to promote financial intermediation and open a door for higher value financial services. It will be a request-to-pay scheme where smartphones and the interbank electronic payment system, which is a real-time gross settlement payment system, will allow for these transactions to take place. It uses QR codes and NFC technologies for easier payments, and instructs and settles electronic payments in seconds, every day, every hour of the year. CODI works as I said, as a payment request by the seller. The buyer authorizes the payment on the mobile device, triggers an instructor to transfer the funds. The payment is settled in seconds, and the buyer and the seller receive the notification of the settlement also in seconds. Among the benefits is the simplicity and have immediate transactions. The process is carried out with high security levels, with control of their account, and quick dispute and resolution process. And no need to wait 24 or 48 hours for settlement, as with current debit or credit cards. Very important, it will have no cost. The payment system network of central bank is well positioned to take the lead and promote financial inclusion in a decisive manner, act in a centralized and decisive way, and cooperate towards implementing solutions for final users. And cross-border instant settlement of currencies and payments and RTGS, I think they and should be on the agenda. Achieve greater efficiency by taking advantage of the infrastructure already in place and reduce incentives for still not stress test solutions arising from private sector, and maintain key safety features like Know Your Customers. Regarding virtual assets, in our case, we have been of the view that regulation should keep a safe distance between virtual assets and the financial system, with regulation applying to traditional financial institutions and to non-financial institutions. Cybersecurity is also a priority. I would go into detail, but I think it is very important to understand that the challenges and the opportunities that come with the digital age also come with some challenges and costs, and cybersecurity is clearly one of them. Going ahead, we must achieve international coordination for fintech regulation to avoid regulatory arbitrage and to share relevant information about risks, new technology developments, and to properly assess the degree of interconnection in the financial system. A key challenge going forward is the potential recomposition of the traditional financial industry as a response to big tech incursion in providing financial services. I'm going a little bit more into regulatory challenges and potential role for central banks. Among the regulatory challenges, I would highlight new ways of providing services, which not necessarily means new financial services. So it's new ways, not necessarily new issues. And big tech becoming a major influence. Unbundling of services will make it difficult for a classification of new services providers into existing regulation. One of our proposed approach would be to regulate activities according to risk instead of regulating institutions. Understanding the new ways, it is critical. Conceptualize financial services in a modular fashion and with a level playing field to avoid emergence of regulatory arbitrage. We should have a proactive response, pursuing a level playing field for all participants providing similar services. We should apply same risks with the same regulatory approach. set the conditions for innovators to emerge in a free, transparent, safe, and competitive environment in a technology-neutral environment. We should also seek a balance between risk and innovation, economies of scale and competition, efficiency and safety, standardization and diversity, privacy and security. Closely monitoring big tech plans to delve into financial services and see if they will act with cooperation as suppliers or as competitors. We may have both, or a blend of both. Wide customer base of big techs aggravates transmissions of operational and financial risks. We need to understand the risks clearly in order to mitigate them. We need not to forget that there is a risk of misdiagnosis of the potential implications and risks of the new landscape under false preconceptions. And that has happened before. Network effects that in this case will be even stronger and faster to manifest themselves. Even operational risk stress tests should be conducted periodically, and we should think about this. Operational risk from increased concentration of IT solution providers should also be addressed and in our radar. Credit risk compounded with potentially long intermediation chains and interconnection can be a problem, and it could be hard to unwrap these in case of default. Security implications, we should have in mind money laundering and counterterrorism financing in real time, cyber risks, data protection, and ownership issues. Fiscal and monetary policy implications of a digitalized sub-economy of cryptocurrency surpassing borders should also be considered, as we can see from recent initiatives. As a final message, let me add the need for a cyber tech prudential dimension. As Andrew Crockett once called for macro and micro prudential dimensions. It is not a matter of breaking the wheel, but making sure that the wheel will take us to a better equilibrium. Thank you.
Thank you very much, Alejandro. And we move directly to the next speaker. Thomas, the floor is yours.
Thank you very much, Jens. It's an honor to be here. Now, as Amit just shown us, fintech companies and shadow banks have brought dramatic changes to credit markets in many countries. Parts of the credit business have migrated from traditional banks to the shadow banking sector, and one of the reasons for this are the stricter regulatory requirement for banks. In my remarks, I would like to review the current developments in the fintech sector from the Swiss perspective. I will argue that fintech companies have not had the same disruptive effect on the Swiss credit market as elsewhere, at least not yet. Indeed, fintechs are rather complementing than substituting the activities of the Swiss banking system. Up front, I would like to state that Switzerland is very open to fintech developments. However, it remains to be seen how successful fintech companies will be in the future. We see a great potential, but of course also some risks. Now, Swiss fintechs are currently particularly active in niche markets. They are opening up new financing opportunities, which can make a lot of economic sense, also against the background of a limited Swiss capital market for SMEs. From today's perspective, however, at least to me, it is inconceivable that fintech companies in Switzerland will significantly replace banks anytime soon. Let me now start by briefly outlining two main features of the Swiss credit market. First, in contrast to other parts in the world, in Switzerland, both private individuals and SMEs finance themselves primarily through the banking system rather through the capital market. The capital market only caters to large companies. Second, the mortgage market accounts for the lion's share of the credit market. Now, so far, fintech companies have not been disruptive to the credit market in Switzerland. Crowdlenders, which are the predominant fintech companies in the Swiss credit markets, are active in the intermediation of loans. The data show, however, that they are not displacing the banking sector. Rather, fintechs cover a credit market niche in which banks are hardly active and where financing via the capital market is not available. Crowdlenders primarily intermediate short-term loans, so up to 2 years, to private individuals and companies with a medium or low credit rating, so consumer and corporate loans, or especially also second mortgages. Crowdlenders thus take on credit risks that banks do not want. In the last decade, the market share of banks in the credit market has been more or less constant. This takes into account the credit volume of fintechs as well as other non-banks, especially insurance companies and pension funds, so the entire shadow banking sector. We thus have no indication that the current regulation, especially capital adequacy and liquidity regulation, has caused the playing field to become uneven. In other words, we have no indication that banks are restricted in their lending compared to fintechs and shadow banks. Now, Swiss banks have adapted their lending conditions, such as interest rates, to the increased competition, and have thus been able to maintain their market share at a constant level. The low share of fintechs, but also of other players, such as insurance companies, should not be seen as a sign of lack of competition, but rather as a sign of the adaptability of banks to changes in the economic environment. Crowdlending has grown strongly in Switzerland, yet from a low base. This strong growth can be attributed, among others, to the low interest rate environment worldwide and to the search for yield. Now, how should we deal with these fintech developments in Switzerland? Crowdlenders complement the banking sector and enable the financing of potentially innovative projects. At the same time, this development also carries new risks. So, for example, it could be a new market for lemons. In my view, we must strike a balance between leaving enough room for innovations and maintaining stable framework conditions so as not to jeopardize the stability of the financial system. In Switzerland, we have made various legislative adjustments. For lending activities, for example, we have abolished the rule that loans to companies or private individuals can be financed by a maximum of 20 individuals. By removing this hurdle, new potential was created, higher credit volumes, and a greater diversification of the investor base are now possible, and this has increased the potential for crowdlenders. Crowdlending in Switzerland is possible without the need for additional permits, but only when the credit intermediation does not involve deposits. This situation changes as soon as customer deposits are accepted. In this area, Switzerland has created a new fintech license to enable innovative business models. Thanks to the fintech license, fintech companies can accept deposits up to 100 million Swiss francs and can offer payment transaction services without a banking license. Now, specifically, the fintech license is designed to reduce barriers to market entry for business areas where profit margins are low. This is particularly the case for payment transactions. This new fintech license also raises the questions of access to central bank money. We have decided to grant companies with a fintech license an account with the Swiss National Bank and thus a direct access to the RTGS payment system if they operate in a significant business model in Swiss franc payments. Thanks to this direct access, retail payments triggered via fintech payment solutions can be processed efficiently and securely in central bank money. Direct access to the RTGS system creates a level playing field between new and established payment providers. However, and I agree completely with Alejandro, it is important that the payment activities of the newcomers be also subject to the same regulations and laws. In other words, to the money laundering requirements. So let me conclude with a summary of my main messages and a look into the future. Switzerland is fundamentally open to innovation in the fintech sector. Fintech companies have the potential to provide new financing opportunities and make a contribution to increase efficiency and economic development. However, their success has yet to be proven. Banks will continue to play an important role. The Swiss National Bank has decided to grant direct access to the RTGS system for licensed fintechs with a relevant business in payments. This enables the implementation of innovative business models and creates a level playing field between new and established providers. However, it is important that the activities of these companies be subject to the same regulation and laws. And to finalize or to finish with a look into the future, so most likely if fintech companies are successful and become bigger, they will get a normal banking license, or another possibility is that they will be bought by other banks. So thank you very much for your attention.
Thank you, Thomas, for these insights into the Swiss case. And I will now ask Lesetja to continue, please.
Thanks, Jens. The advantage of coming forth is that you can avoid the controversial issue and agree with what everybody had just said. But let me thank Amir for the paper. I just have three observations to make. The first observation is what I would call heightened awareness of the butterfly effect and unintended consequences. It is intuitive that our financial ecosystem is dynamic and interconnected. The analysis is striking as it moves beyond intuition and presents a rich and in-depth analysis of this dynamism within the residential mortgage origination market. It draws attention to the players, being banks, shadow banks, and fintechs, and their contrasting interactions with regulation and technology. The analysis is convincing in explaining the nearly doubled growth in shadow banking mortgage share and similar growth with online fintech lenders. What stands out from this analysis is the importance of this concept that I call the butterfly effect, meaning adjustments in one part of the ecosystem and the resultant and sometimes unpredictable or unanticipated impact in other parts of the system over time. Changes that may seem disconnected may over time have significant impact on the system. In this case, the growth of shadow lending. And I think that it's important as regulators that as we introduce new regulations and new policies, that the discipline of doing regulatory impact assessments becomes very important. That said, I think that we are also faced with a situation where we can't pick winners, we can't pick technologies, people must come with the technologies, but we also have a responsibility to protect the perimeter of the licenses that we issue. So if you conduct yourself like a deposit taker, we shall regulate you like one. If you conduct yourself like a credit provider, we will regulate you like a credit provider. And I think that is important that we make that clear. So as we create policies and regulatory interventions, we have to keep reflecting on the possible consequences, the intended and otherwise, and importantly, attempt to quantify what we think the regulatory outcomes are. So regulatory and policy making agility coupled with the ability to accurately measure the impact of policies and regulation is therefore likely to become increasingly important. An immediate open question is whether we currently have the necessary tools, techniques and adaptability as regulators to assess these consequences ex ante and in flight? And if not, what mechanisms will be put in place to build these capabilities? And I will come back to this when I deal with my third observations. And just to conclude my stuff on this first observation, is that it would be interesting to understand if the analysis had drawn out any normative suggestions for whether the regulatory treatments applied, such as increased capital requirements, should have prevented or changed the mortgage lending case reviewed. What would have happened if we didn't change the capital requirements for the system? What kind of system would we have had? Have we forgotten that in putting these capital requirements, we were trying to correct something that actually put us into a crisis? And I think that that reflection is going to become important. The second observation becomes important in the light of Chapter 3 of the Annual Economic Review. The importance of data and data-driven insights to understand these new business models. An important aspect of the analysis is that it brings data or evidence-based arguments to the forefront. For example, it is often assumed that the primary business model or main value proposition of fintechs is reduced costs and targeting the underserved. The data and analysis demonstrate that fintech credit intermediation specifically focused on less risky borrowers and that hassle-free, speedy origination of loans was of greater importance. Such convenience even attracted higher premiums rather than bringing down the costs for the customers of financial services. This data-driven analysis challenges underlying assumptions and casts a light on approaches by different players to the same activities, in this case lending, and their varying business models. The data further confirms the contrasting originate to distribute model by shadow players as opposed to banks, who more historically hold on to the assets in their balance sheets for longer periods of time. Such data-driven insights are extremely valuable in understanding that although the activity or economic function is the same, that is credit intermediation, how they are provided by different players are different. The suggestion then is that activity-based approaches are important and necessary, but may not be sufficient to understand the resulting risks applied through application of different models. The case for better understanding business models through the data and then drafting respective policies is strong. Now, turning attention to the availability of fintech data, I'd like to split this into two. At this stage, maybe I might bring a South African perspective and say that fintech data is not as available as traditional banking data. The collection and analysis of broader fintech data is likely a significant gap in many countries. Given what has been presented, the efforts on collecting fintech data must actively continue to address these gaps. As noted, data and evidence-based analysis should assist authorities in understanding different business models and in making appropriate policy decisions specifically with regards to fintech. We continue to adopt an activity-centric approach to regulating fintech innovation. The data, though, will ensure regulatory treatments are proportionate to the risks evidenced from the different business models. The second aspect of the data has to do with the ownership of the data. And I think that what had come through in the morning also in Shin's presentation, this is becoming an increasingly contested area. And when I conclude, I think that we are going to need a global approach to this, given that most of this data, in any case, ends up being international or being in the hands of the big international tech companies. And then let me just come to my third and last observation, which is the case for joint policy making, coordination, and collaborative structures, not just at a national level, but at an international level. The analysis has also accentuated the need for seeing the trees and the forests, the need to understand granular detail as well as connect the dots and see the bigger picture. The analysis evidences how rapidly the environment can shift and new players can become dominant in shorter time frames. Rapid emergence and adoption of new technologies will likely see increasing innovation and new models evolve faster than ever before, challenging the status quo. As the complexity in the environment shifts, so too should the approach by regulators. The suggestion that developing policies and regulatory frameworks is in silos is passé. As an example, analysis must include what's happening in fintech as well as the impact of incumbents and vice versa. Thus, once more, highlighting the crucial importance of regulatory agility and the importance of measuring impact of regulation on an ongoing basis. So to stress the importance of coordination and collaboration, over the recent few weeks, much hype and attention has been created by the announcements of Facebook. The Libra has renewed sentiment that current monetary payment systems are likely to be disintermediated by giant techs, in this case Facebook, or a combination with big tech firms. This is just an example of the kind of change that fintech phenomenon may deliver. Its speed, scale, scope, and spread has potential to impact the financial system within shortened time frames. Such analysis cannot happen in isolation. A new approach in environmental scanning and ultimately policy making and regulating may be needed. I mean, importantly is that we probably would need to be bringing to bear more of the economist types into the regulatory space, because economists understand the importance of trade-offs. So as we think about the regulatory objectives, be it financial inclusion and financial stability, we might think they are complementary, there might be contestation. Do we think of the need to bring in competition and the need for data protection? That basically means that at a national level, we are going to need coordination between the financial regulators, the competition authorities, and the data regulators. And as I had pointed out that many of these dimensions are international, we actually need to get international collaboration going. And oh, please, don't tell me about memoranda of understanding. These tech firms are not waiting to sign memoranda of understanding. They are doing it, and we better prepare ourselves to deal with an environment we have rather than the one we wished we had.
Thank you for that forceful plea. And we move to the last speaker on the panel. Yigang, please, the floor is yours.
Thank you, Yan. I enjoyed Amit's presentation, and thank BIS for organizing this excellent event, Andrew Crockett Memorial Lecture. I would like to take this opportunity to make 4 comments. First one is central bank should encourage financial innovation in fintech area. People's Bank of China provides a friendly regulatory environment. They allow big tech companies to expand their business to many areas, including mobile payment, small and medium enterprise loans, insurance, money market, and also banking business. Actually, People's Bank of China and CBIRC grant Alibaba and Tencent, each of them a bank license. But as a mid-paper pointed out that doing business through banking license is expensive. So that if you look at the past years, their banking balance sheet has been growing at a very slow level. They are doing most of their business in non-banking business because it's more cheaply. And therefore, we should have this regulatory friendly environment. That's the first comment. The second comment is that what is the benefit of those big tech companies and fintech innovations? Obviously, they increase the competition and make the financial service better. And secondly, they provide inclusive finance. In our case, they make more access to the financial market in the rural area. They provide a lot of small and medium enterprise finance and microloans to the business sector. And also they make the overseas remittance much cheaper. So that's the benefit. And overall, I can say that you see those big tech companies and financial innovations make the entire financial market more efficient and the allocation of resources more efficient to economic development. That's the second remark. Thirdly is about what is the risk and the challenges. And of course, those kind of big tech companies also bring to us a lot of challenges and financial risks. First, they competing in the deposit market. As Amit paper pointed out that you see the typical big tech company in the United States, they have 75% their liabilities coming from the bank credit, borrowed from the banks. In our case, actually those shadow banks, they actually directly compete in the funding market. So they make the interest rate much higher. And also the second challenge is about information protection, especially private information. You see, the entire Amit paper is about the information. You see how the big tech company, they can use big data and information more efficiently. But the problem is that in this process, we see some abuse of private information about individuals, families, and business. That's the challenge. The third challenge is a monopoly. You see, in this game, winner takes all. And so that monopoly is a challenge. And the fourth challenge is about money laundering and know your customer requirement, whether it's have a good compliance or not. Those are the challenges. So that's one thing. The other important thing I want to mention here is that we have to have the borderline between the central bank and big tech companies to be clear. I gave you an example. For example, in the past, our big tech companies, they do the clear and settlement business among commercial banks. They open account over more than 200 commercial banks. And then they actually doing the netting and the clearance as if they are a second central bank to do the business. In the past 2 years, we gradually correct this kind of wrongdoing, and we make all the third-party payment companies connect to a company called Net Union, and the Net Union connect to the RTGS of the central bank, so that's the level playing field. And also we make sure that all the consumers' money balance in their third-party payment account. Right now, we make all those money deposited in the central bank, and that is also to prevent the money pool business and also provide equal competition from all the business. So I think that's the lesson and experience I'd like to share. And basically, we want to prohibit the big tech companies from seeing the market share through cross-subsidization and dumping behaviors. And lastly, in this regard, international cooperation between central banks and monetary authorities, regulators, are very important. Thank you.
So thank you for the very thoughtful remarks from all of you. There's not much disagreement in terms of what all issues you have raised. I think one thing that I saw as a consistent theme was we need to think about data, because a lot of fintech shadow banks are working off of data. Here, the issue is how are regulators going to understand what is the data being used and what are we going to do about it? Is this something that's going to be available to banks? Is this something that, how are we going to think about the privacy element of data? And there is a global element here as well, which I didn't talk much about, but all of you raised, that a lot of these fintech firms have done pretty well locally in local markets, but they all have ambitions to think global. And as they think globally, the question is, how are they going to get data? How are they going to leverage that data? And what is the regulation going to look like? How are we going to regulate that? That's a pretty complicated issue, but something that we need to think about. The one theme that I thought was very interesting, and I didn't emphasize as much, but I fully agree, is that regulators need to think very carefully about data and data analytics when they are thinking about supervision and regulation right now. Now, it's the case that, for example, in Switzerland, that fintech firms haven't necessarily outcompeted banks for various reasons, but still they are growing and they are doing things which involve usage of data, and that is something that regulators will need to think about. When you hire data scientists can crunch numbers for you, can run models for you, but the intuition, thinking about what exactly are the trade-offs, will have to come from you. But you will need a lot of data analysis and analytics, which fintech firms are doing, so to understand what is their business model and how are they sort of competing with banks, collaborating or competing, you will need that element. And if you think that you can wait, that will be, I think, too late, as was pointed out. So I think those are the two elements that resonated with me quite a bit, and everything else I pretty much agree. On the risks related to fintechs and shadow banks, cyber risk is big. How should we deal with that is something that I'm sure all of you are thinking about. It's unclear what's the best way to think about these things, especially on a global dimension. But with that, I think I would like to open the floor.
Thank you. So now it's time for questions to Amit and the panelists. Please go ahead. Do we have microphones, or? So we start in the first row here in the middle, to my right.
Thank you. Thank you very much for an excellent lecture. Very interesting, particularly for those of us who don't know much about the current developments in the U.S. mortgage market. But from what I got, the most interesting thing were first slides and then the last slide. Because you show that there's a rapid increase of the shadow banks, not only in the US, but also in Europe and in China. And then you go to explain that 75% of their financing comes from the short-term bank debt in US at least. Now one wonders whether this increase then in the US that they had of 30 percentage points is not actually an increase of 7.5 percentage points, and the rest are banks, again, who basically originate and sell through the more efficient intermediator and actually sell to the government, which is a very specific market because you don't have it elsewhere. You have it in the US, where it all ends up in the end with the government, but it doesn't exist in Europe or in China. So then you have one explanation for US, why the shadow banks increase in share. You have probably different in China, as he has said, there they even compete for the deposits. And I wonder what happens in Europe with that rapid increase, because they don't compete for the deposits and they don't have somebody on the government side to buy in this originate and sell part of the fintech business. Huh? So that's the question. How do you explain that, and how do you see these differences? A question for Thomas is this 100 million that they can take, this is uninsured deposits, I guess. They don't belong to the DGS. It's not guaranteed deposits. It's like people know, so you limit, there is no risk for the government or for the deposit insurance scheme, and you limit the private risk to 100 million in order to get a little bit better, more efficient intermediation and the system. And in China, also insured versus uninsured deposits. When these guys compete for the deposits, they know what kind of risk, the customers know what kind of risk they are taking, or how do you look at that?
Thank you very much. My suggestion is that we collect a couple of questions and then let you respond, because we're a bit short on time and the interest is quite extensive, I would say. So I have Fabio next, Ewald then, and then we move here to the middle of the block, so to speak. So Fabio.
Fabio Bernetta from the Bank of Italy. First of all, I want to thank Amit for the very, very clear and comprehensive presentation. One thing that I do not understand in your presentation is why, I mean, you show that banks are losing substantial market shares, and I do not understand why they do accept passively to the loss of this market share without reacting. After all, the technology which is used by mostly small fintech companies should be available directly or indirectly to banks. So why are they accepting this loss of market share? Unless there's something different between the borrowers of the banks and the borrowers of the shadow banks, because they might have different risk profiles. For example, the shadow banks are using the OTD model, so they might afford to have riskier customers. In this case, from a macroeconomic point of view, we might have in the future a big problem. Thank you.
Thank you, Fabio. Perhaps you can just pass on the microphone to Ewald.
Yeah, thank you very much.
His last intervention at the BIS meeting.
Just one short question. At the start of your very interesting presentation, you gave this impressive map according to counties, where there are differences in the counties. And if I understood it correctly, you showed the argument was that those counties where there is a higher regulatory burden are those where the fintechs can advance. So first, I'm not so sure what could be these regional or local differences in regulation. And second, couldn't it be that behind this is just the point that these counties, these higher regulated counties, are in fact counties where the banking system has problems, and therefore they have to prepare for higher capital ratios. So that in fact what you are measuring is the quality of not regulation, but the quality of the banks in these regions.
Well, we take you and then we take you. I mean, I saw you, so don't panic. You get the microphone after that. But then we have to close the list for this round. So please go ahead.
I'm actually the one who was trying to get everybody's attention. I think in Kenya what we have is something a little different. We have tighter collaboration between the banks and the fintechs, which I didn't hear discussed. So the outlook really is that the complexity of banking is better done by bankers, and the efficiency, data analysis, speed, safety, and particularly when you look at cyber, is better done by fintechs. And so there's collaboration between the two. And so what you don't have is you don't have the distinction that perhaps I'd heard in the discussions. I think for regulators it helps with oversight, and it also protects us from virtual assets being produced. I think our concerns as we go forward is data protection, payment solutions. There's new payment solutions coming out all the time. Cyber threats, AML, CFT, and cross-border, which is just starting. So I think there's different approaches used in different places, and I think that's the point I really wanted to make.
Thank you very much. Now you can just pass it across.
Thank you very much. One comment I think the paper of Amit is very interesting, but it's far from what we were discussing this morning, because we were discussing the advantage that big tech has to get the information of their own network. And in this case, as if I understand you well, we can take the information of, they are refinancing mortgage, so they take the information from the client and from the mortgage base, and they get, the only thing they provide is a quicker way to answer the clients, and for that they are able to pay, or they're willing to pay a higher rate, and they need a higher rate because they have to sell them, and they have to sell them with a profit. And in the other point, as they was mentioned before, you have the government that in general, if you look at the past history, is not a very clever buyer. Saying that, I have a question to Alejandro and to Thomas. You mentioned the payment service providers. As you know, we have two different payment service providers. One, that there is just a technology platform that links credit cards or whatever with the electronic commerce, and they not put nothing in the middle more than the infrastructure. And there are payment service providers that they have virtual accounts. They have a floating. They may have credit. They may give loans and so on. So, have you different the treatment of these payment service providers in the Mexican law, or how you treat the ones that have virtual accounts and they are acting as a bank? And for Thomas, what covers the license you are giving to the fintechs? If they also include, well, as it was asked, the virtual accounts, what with insurance and so on. Thank you very much.
Thank you very much. Amit, I suggest that you start because most of the questions have been addressed to you, and then whatever you don't want to answer, leave it to the colleagues.
All right, let me group all the questions in a few buckets. So one bucket of questions is that, is this something that's specific to the US mortgage market because there is a government as a buyer and that just distorts everything that you're seeing? And you know, that was not the message that I was trying to communicate, but it seems to have gone across. If you look at what I was trying to sort of argue, and if you see what Quicken is doing, it's not just that they are selling to the government and that's where all the distortions or differences are coming from. Because when I showed you that interest rate difference, both are loans that are being sold, but the Quicken loans are being originated at a higher rate. And that's why I said that that is a premium for convenience. I didn't have time to get into details, but if you dig deeper, what you see is that all that premium is coming from higher creditworthy borrowers. So within higher creditworthy borrowers is where you see that I'm able to charge a premium. Other places, not so much. So there is something about data, and we can talk more about what exactly they are pulling, but Quicken used to be part of TurboTax. So it's not just that they are doing refinancing and therefore they can get information that exists out there. Of course they can. But it's also that they have information about your tax returns. And they are able to use that in ways that normal banks cannot. Because if you have tax return data, it's in a PDF file. How do you take that data and then put it in a way that you can actually crunch numbers and get some insights out of it? They have mastered it. Why are US banks allowing this to happen or not copying this? I mean, they have a different business model. There is a cost of doing this. And banks have decided that they face too much regulatory pressure to originate mortgages and keep on the balance sheet. So they have retreated from wherever it's not competitive. When it comes to the segment where they are the only players in town, they are doing exactly what they were doing before and competing pretty aggressively. Now that brings me to this set of questions which said that, hey, look at Swiss case, or look at China case, or look at the case in Kenya where there is collaboration, not necessarily competition. And that's totally fine. My point is just that, like, if you want to do regulation going forward, you have to think about the business models that fintechs and shadow banks are doing and how that interacts with the banks. Now, it may very well be, like you said, that in some countries they collaborate. In some countries they compete. But when you're making a policy, let's say you're changing the capital requirements, or you're thinking about changing the monetary policy, how that is going to get transmitted to the real sector is going to be a function of what these two entities are going to do and how they are going to pass this to the real sector. And in the US context, it will pass in a certain way. In the Swiss sector, it will pass in a certain way. But it might change in the future, and we got to sort of think ahead and be able to talk through that. Now, there was a question about the interesting things being only in the beginning and in the end. So that's great. That's where I wanted your attention. But I think that misses one element which I wanted to emphasize, which was, I was trying to argue that there is the element of the old famous Lucas critique behind all of this. Now, different countries different environment, different structure, but unfortunately we have to get our hands dirty because the business models are quite different than what we are used to. And if you don't get your hands dirty, you will not be able to understand what the intended response is and what you're actually going to see. And I was just trying to illustrate in the US context that here are two simple policies and you get completely different responses. But if you understand the industrial organization, and yes, it's very messy and government is very special, but if you understand that, then you can make sense of it. But if you didn't, you would look at it and you would be just not sure what is happening. Why is this getting a response which is amplified in one case and dampened relative to what your expectation might be if you just focused on banks? And the last thing is, when we think about where shadow banks and fintechs have expanded, are these regions which are messy? Are these banks which are messy? So without getting into details, and we can talk offline on how we were able to see which regions have more regulatory pressure and which don't. What is interesting is that there are some ways in which you can just look at what happened to the supervisor. So there are some supervisors which were present in some regions, and then some supervisors were shut down. So nothing else changed, but the extent of strictness of the supervisor changed, and you can see that fintech shadow banks entered wherever strict supervision was there, and fintech shadow banks did not enter where strict supervision on banks was not there. So it's not about the banks, it's not about the area, it's more about supervision, and we can chat more. But that's pretty much what I have.
Thank you. Alejandro, please.
Yes, very quickly. In terms of fintech, do they compete or do they complement or coordinate? I think, and we should expect both. I think fintech are information IT solutions or IT approaches searching for efficiencies. And they may collaborate or they may compete depending on which type of efficiencies they can solve. And we hope to get both. And in terms of payment systems, there are basically two, the wallets, and the wallets need to have one-for-one backing to what they issue. And the other is the more traditional payment system. And I would say that those are two separate lanes with different regulation and obviously different, not the banking type of full regulation applying to the wallet.
Thank you very much. Thomas, you got a very specific question from Boris, but feel free to answer whatever you went on top.
Thank you, Jens. Well, basically, two issues. Well, Boris' question was regarding this fintech license. And this is indeed limited to 100 million Swiss francs to taking deposits, but at the same time, it's also very restrictive. So you are not in the business of giving loans to anybody else. So mainly, the assets remain in the banking sector as deposits with other banks or as liquid assets with the Swiss National Bank. So they do not take any credit risk. And to my knowledge, they also are not part then of the deposit insurance scheme because it's not necessary, because there's no risk-taking in that sense. Regarding your question, I believe the ambition is to have a very efficient payment system in Swiss francs so that everybody that plays a certain role has a direct access. And if there is any innovation that make payments easier, faster, cheaper, they should have access and then help to produce a more efficient system. And my last remark is regarding to collaboration between fintechs and others. And if you take the Swiss case where we have no big capital market, then basically fintechs can remain in the niches, but they can also provide the technology both to banks or to non-banks. So already what we see is that banks use technologies very similar to fintechs where they can provide mortgages over the internet, very similar to what Amit just told us, or to make the credit evaluation more efficient. So this technology will be available over time to everybody, and everybody who has an interest will use it, independent whether it is of fintech companies, banks, or shadow banks. Thanks.
Thank you, Thomas. Lesetja?
A very quick one. I mean, I thought I didn't hear properly, but since Amir clarified it, now I am more worried than I was about data. A fintech company having access to my tax return, that's a serious violation of my privacy. And so it raises even bigger issues of how they got access to this one. I think that there is some political contestation in the US of a politician who doesn't want his tax data released, and then meanwhile, I should have just gone to the tech company because the tech company has it. So I think it's even more worrying than I thought it was.
Thank you for putting it into context. So, Yigang, please.
In China, deposit insurance up to 500,000 renminbi only to deposit-taking financial institution. No shadow banking. Thank you.
So given that we've overrun the allocated time already, let me conclude today's panel by reminiscing once more about Andrew Crockett. In his last public speech as general manager of the BIS, and this was in March 2003, Andrew reflected on ways how to secure both monetary and financial stability on a sustained basis. At the same time, he reminded the audience, and I quote, that the ever-changing nature of the challenges calls for vigilance on an ongoing willingness to re-examine critically even well-honed convictions. So I'm sure that this timeless advice will help us in dealing with present and coming challenges, with fintechs and others. So thank you very much for your attention, and have a nice rest of the weekend.